Why would an LLC be a disregarded entity? Have you ever wondered why some limited liability companies are considered disregarded entities? This classification can be a bit confusing, but understanding it is essential for business owners. Let's break it down in simple terms. An LLC is a type of business structure that offers liability protection to its owners. However, when an LLC has only one owner, it can be treated as a disregarded entity for federal income tax purposes. This means that the Internal Revenue Service does not see the LLC as a separate taxpayer. Instead, the income and expenses of the LLC are reported directly on the owner's personal tax return. This arrangement simplifies tax reporting. The owner files their business income and expenses on Schedule C of their personal tax return. This is much easier than filing a separate tax return for the LLC, which is a common requirement for corporations. Now, this disregarded entity status applies only to single-member LLCs. If the LLC adds another member, it is generally treated as a partnership for tax purposes. This means it would no longer be considered a disregarded entity. By default, single-member LLCs are classified as disregarded entities unless the owner chooses to be taxed as a corporation. This is done by filing a specific form with the Internal Revenue Service. Choosing to remain as a disregarded entity allows for pass-through taxation. This means the business profits are taxed only once on the owner's personal return, avoiding double taxation that corporations face. Even though the LLC is disregarded for income tax, it still maintains its legal status as a separate entity. This is important because it protects the owner's personal assets from business debts. A common mistake is confusing tax treatment with legal liability. Just because the LLC is disregarded for tax purposes does not mean it loses its liability protection. It is also important to note that while the Internal Revenue Service may disregard the LLC for federal income tax, many states still recognize it as a separate entity for state taxes and fees. Business owners must be aware of these state-specific requirements to avoid compliance issues. Additionally, disregarded entity status only applies to income tax. The LLC may still be responsible for employment taxes and other obligations. Owners sometimes overlook these responsibilities, which can lead to penalties. Misunderstanding the disregarded entity status can lead to several common legal mistakes. For instance, failing to file the correct tax forms or misunderstanding personal tax responsibilities can create problems. Another mistake is assuming that disregarded entity status means there is no separate legal entity, which can lead to mixing personal and business assets. In summary, an LLC is considered a disregarded entity primarily for tax purposes when it has a single owner. This simplifies tax reporting while maintaining legal protections. Business owners should clearly understand this classification to avoid common mistakes related to tax filings and compliance.